Hello, accounting students. It's a time to look at some problems in the textbook. If you go to problem set A, that's problem set A. Most chapters have a problem set A and a problem set B at the end of the chapter. But let's go to A. And if you then go to PA6, that is problem set A, number 6, you're going to see a chart, for want of a better word. And it's a chart of transactions. Now you might say to yourself, well, what are transactions? Well, transactions are anything that happens, any event that occurs that changes the value of a company. Now you might say, okay, but what is the value of a company? How do we compute it? Well, let me give you an example. Let's say I'm a company. And let's say that I have $5 in my pocket and I don't own anything else in the world. Even the clothes on my back are borrowed. So I would say I still have $5 in my pocket. That is something that I own, that is an asset. Do I owe anybody anything? Well, let's say I owe you $2. We would say that those $2 that I owe you, that debt, that obligation, is a liability. And so, what am I worth? Well, if I have $5 in cash in my pocket, that's an asset. But if I owe you $2, that's a liability. An accountant would say, I am worth, my value, if I were a company, is 5 minus 2 equals 3. We've just concluded, not the entire course, we got more to go, but we've just concluded our discussion of the fundamental accounting model. It's all about understanding value or worth, how much you are worth, what is your value. Sometimes you'll see the word equity used or the phrase equity value. It still means value. Here in PA6, you see the basic equation set up. Assets minus liabilities equals owner's equity. And they have a list of transactions, each of which presumably is either going to change the value of the assets or the value of the liabilities, and therefore change the value or worth of the company overall. And that's the purpose of PA6. Now let's go a little bit further down the problem set, or problem set A. And let's go down to PA8. Problem set A, number 8, PA8. This is a little bit more complicated than the example I just gave you because there isn't just one asset, $5 in cash, but there are 3 assets. This company owns 3 different types of things that have some value. Well, the company does have some cash. Company also has inventory. That might be a bunch of supplies, computer supplies maybe, or this might be a retail store where the company buys inventory with the expectation of reselling it. A company also has some equipment. Maybe it's a set of computers, maybe it's some cell phones, maybe it's a truck. But those are the 3 assets this company has: cash, inventory, and equipment. It owns all three of them. All three have value. They're worth something. Company also has a couple types of liabilities. Accounts payable is a type of liability or debt that occurs when you go to a store or a vendor and you say, hey, sell me something and I'll pay you a little bit later. In other words, let's open up an account for me. I'll order up to a certain limit every month, and perhaps I'll pay you at the end of the month. Well, at any given point in time, there might be an outstanding balance. Monies that I have not yet paid, but which I owe, and so we call them payable, meaning I will be paying them shortly. These types of vendor accounts create what we call accounts payable. Debts, obligations, liabilities to pay someone something in the near future. This example, PA8, has another type of liability, wages payable. Basically, our workers work for us and we don't actually pay them for their work until payday, which might be at the end of the week, might be at the end of the month. And so as workers continue to work throughout the week or throughout the month, the amount that I need to pay them, if I am the company, increases. If they keep working, but in that moment that they are working, if I have not paid them yet, then the salary that I owe them is not yet paid, but is payable. And that's what wages payable means. Finally, there are two different types of ways to earn value or to increase how much you are worth. And they are listed in the owner's equity or equity value columns. You could either increase your value by working hard to operate your business and basically to earn your keep and earn the value. If value increases or changes in general while you are working hard to operate your business and earn money, then that value is considered a part of earnings. And we put those value increases or decreases in the retained earnings column of the value section of this chart. But there's a different way in which you might increase your value. An investor might just come to the company and say, I like you. I want to give you some of my money to invest in you. And you, in return, will give me a piece of the ownership of your business. If you think about it, if a company gets a lot of money and therefore increases its value, not because it operated itself and earned it, but because an investor just gave it to them, then value does increase, but not because of earnings, but rather because an investor gave them cash, requested a receipt called a stock certificate in return, and we would call that type of increase in value common stock, meaning that value went up because an investor gave us money, not because we as a business worked to earn it. Now, if you look at PA8, you might be thinking, okay, Mike, so I see 10 rows. That means that 10 transactions occurred. How do these numbers actually work? Well, let's look at row 1. What happened in row 1 is that an investor gave the company $50,000 to buy a piece of the company. And the way you figure this out is as follows. You ask yourself, okay, company just got $50,000 from an investor. Question 1, have any assets changed in value? And the answer is sure. Cash has increased by $50,000. That's why the $50,000 number is in the cash column of row 1. Have any liabilities changed? No. And thus there are no numbers in the liability columns of row 1. Well then, if assets minus liabilities equals value, and if assets increase by $50,000 while liabilities do not change, then value must increase by $50,000 as well. Which value column in row 1 gets the increase of $50,000? Well, an investor gave us the money. We did not work or operate our business to earn it. And so you put the $50,000 increase in value in row 1 in the common stock column. Okay, let's look at row 2. Here, the company spends $6,000 in cash to buy an awful lot of inventory. Maybe it's expensive computer supplies. That could get expensive, you know. So you ask yourself, okay, we just spent $6,000 in cash to buy inventory. Have any assets changed? Well, actually, 2 assets have changed. One, we just spent $6,000 of cash. Number 2, we just bought $6,000 of inventory. So as you see in row 2, the cash asset decreases by $6,000. The inventory asset increases by $6,000. Assets overall, net, right, total between the two, do not change in total. There is no effect on liabilities. And so, if overall total assets do not change, and if there's no change in liabilities, then value, which is assets minus liabilities, do not change either. And that is why there are no numbers in the value columns in row 2. Value does not change. Okay, let's move on to row 3, and then I'm going to hop down to row 10. But let's look at 3 first. What happens in row 3? We buy $22,000 of equipment. But we don't have the cash, or actually we don't want to spend the cash. And so we open an account with the equipment supplier. And we say, give me $22,000 of equipment. I am buying it. And I will pay you the money at the end of the month. Has any assets changed? Yes. Equipment increases by $22,000. That is what I bought. But for the first time, have any liabilities changed? Yes. Because we're not paying with cash. We're agreeing to pay at the end of the month. And so we now have a liability called accounts payable for $22,000. Well then, if assets increase by $22,000 and if liabilities increase by $22,000, then assets minus liabilities do not change, and thus we do not write anything in the value column because assets minus liabilities equals value. Now, by the way, be careful. Many people say, well, if assets increase by 22 and if liabilities increase by 22, value increases by 22. No, it's just simple arithmetic, but that's so easy to make that error. If assets minus liabilities equals value, or if you like 9th grade algebra, if A minus L equals V, and if A and L both increase by the same amount, V does not change at all. Okay, let's look down at row 10, which is just a little bit different than row 3. That's because in row 10, we buy equipment, but we don't run a tab. We don't incur a liability. We just pay for the equipment in cash. And as a result, in row 10, when we ask ourselves, have assets changed? Sure. Cash goes down by 1,000. Equipment goes up by 1,000. And so assets overall in total do not change. There's no impact on liabilities, and thus A minus L or V value does not change either. There are thus no numbers in the value columns. Okay, phew, we have 3 more rows to cover and then we're done. Rows 6 and 9 are pretty much exactly the same. What is happening in rows 6 and 9? We hire someone to do a little work for us. And we tell them, I know I owe you a payment for the work that you did, but I don't have the cash yet. I'll pay you later. Bill me. And so when that happens, whether it's somebody who is mowing the lawn or cleaning your facility, doing something like that, personal services, if you will, then you say, after they complete their service, and once you promise to pay them, you think to yourself, or you ask yourself, you say, have any assets changed? Well, not yet, because I haven't paid them yet. Have any liabilities changed? Sure, I now owe them money, which is why in rows 6 and 9, liabilities, accounts payable, increase. And so you conclude, well, if A minus L equals V, if assets do not change, but liabilities increase, then value must decrease. That is why in rows 6 and 9, you have decreases in the value. And since somebody is doing work for you to help you operate your business, this has nothing to do with an investor giving you money. Those decreases go in the earnings value column not in the stock or investor value column. There's only one other row we have not talked about yet. That's row 7. And row 7 is actually a lot like 6 and 9. Someone is doing work for us. We haven't paid them yet, but we owe them money and we will pay them in the future. In row 7, since we have not paid them yet, there is no change in cash or any other asset. We now owe them $3,000. That's a liability. And if assets do not change, but liabilities increase by $3,000, the value of the company will decrease. Why are we calling this liability wages payable instead of accounts payable? Apparently, the people doing the work that we owe money to are our own employees. They're not outside contractors. Because they're employees, we pay them wages. Whereas if we owe an outside contractor anything, we would open up an account with them. Different liabilities with different labels, wages payable and accounts payable. But the fundamental transaction, somebody does work for us. We haven't paid them yet, but we will. There are no changes to assets yet, but liabilities have increased, and therefore value decreases. Rows 6 and 9 and row 7, they're structurally or conceptually the same. Well, that concludes our journey through PA6 and PA8. I hope that you've enjoyed, or at least understood and appreciated, this verbal discussion of these problem sets, and I look forward to continuing these audio recordings in the next module.